Hello, this is Andrew Fake from Minds and Money. Delighted to be joined with us today by Matt Fifield, Managing Partner at Pacific Road Capital. Delighted that you can join us, Matt.
Thank you, Andrew. Thank you. And thanks for having me on Minds and Money.
A key theme of 2022 and indeed of previous years has been the energy transition. Opening question, are investors leading the way in the energy transition?
Honestly, I think that investors, and by investors, I mean broader based investors, are really playing catch up. So if you think about where capital flows have been and where they are today, really perhaps into maybe October, there was what I would think of as the first wave of people saying, wait a minute, there's actually a supply crunch. So last year in 2021, there was a lot of interest in mining that was absent from the previous 5-6 years. And then there was a big sell-off from, say, October, November into and through to probably February. And then, of course, with current geopolitical tensions, there have been and a sell-off in the broader equity markets and a tilt away from tech. Cyclicals are looking actually very interesting. And there's now more capital flowing back into the sector. But it's really, from my perspective, I think that people are late. I think they're playing catch up because, to some degree, this has been a very solid investment opportunity for a long period of time.
Mm-hmm. In terms of Pacific Road, can you give us some examples as to how you are leading the way in terms of energy transition and some of the initiatives that you've undertaken?
Sure. I wouldn't say that we specifically are leading the way in energy transition with our investment plan, but what I would say is we're very conscious. So think back about what we've talked about over the last, say, 4 years, 3 years, very conscious about ESG, very conscious about the incumbent value of a producer in their ability to grow into a rapidly changing marketplace. And at the moment, one of the things that's been interesting as you go through COVID, we're in a period where we're locked down, people aren't traveling, M&A is somewhat frozen. And so we shifted from making illiquid, highly concentrated bets in companies to more towards seeing what's going on in the broader equity markets. And that's been a profitable strategy for us. What we are doing with respect to energy transition, you cannot ignore the fact that metals are energy. So metals are energy, and energy is political, and it's all around us all day long. So when we think about our public investment format, what we're doing is basically taking a very positive allocation to a number of the metals that are, no surprise, lithium, graphite, nickel, copper, rare earths, all of the areas that are in high focus, not only from generalist investors and newspapers, but in particular from legislators and government, fundamental government programs. And what you're seeing is these areas crop up again and again in the Build Back Better plan, or the strategic minerals, or critical minerals, or supply chain talks. And everybody's wondering, where is this going to come from? So that's where we've been spending a lot of our time focusing in that growth segment of the market. It's the fastest growing area in commodities.
One commodity you didn't mention there was uranium. Would you see investing in uranium as being part of the energy transition?
It's a very interesting question. When you look at the EU taxonomy, for example, both gas and uranium are a part of it, and a shift towards nuclear. On a personal basis, I think it's very challenging because we could store, years worth of uranium in our offices. And so the inventory effect in uranium makes uranium miners, well, they're really exciting and they're a lot of fun because they're very volatile and they move all over the place with news. But that being said, when you peel back and you look at, is there fundamentally, a lack of capacity to supply, say, the United States, which is the world's largest nuclear market? The answer is no. There is lots of uranium fuel around, and the cost curve on that uranium fuel is relative to today it should work. So we don't see as anything like the growth in demand in uranium that you would see in all of the battery metals. In all the battery metals, the growth cupboard is already there or getting there. There's very little growth on the supply side, and the demand side is saying, deliver me multiples of where we are today. That is a very favorable set of investment trends. Anytime an industry is trying to 2x, 3x, 10x over a decade, there's going to be a amount of value for advanced projects and for incumbents with organic growth pipelines.
Mm-hmm. Taking one of the battery metals that you mentioned, lithium, if you, Pacific Road, are looking to invest in a lithium project, how do the challenges sort of vary, or the challenges and opportunities vary between investing in the exploration stage as opposed to development or production?
Sure. Well, look, actually, if I could pull back for a second, across each one of these areas, when we're in a liquid format as opposed to in a highly concentrated format, we're actually looking across the spectrum. So in lithium, we own mature dividend producers that are rewarding shareholders. What happens there is if there's a run in prices, dividends or share buybacks increase, and that's good for us as an owner. We're looking at high organic growth producers, where high prices mean that their growth programs are de-risked by excess or sort of above people's expectation of cash flow production, and it offsets some of the cost inflationary pressures that we're seeing in the market today around project builds. And then we're really looking at what's the next generation of supply. And the next generation of supply, look, we're mine builders and we're mine owners. And so it's taking a look at, are you thinking about your metallurgy? Are you thinking about your people? It's really all of those precursors to building a business. It's people, permits, stakeholders, ESG. Are you aware and thinking about things like IRMA and alignment around tracking the carbon inputs or the some of the supply chain alignment that you need to be servicing big OEMs? Do you have a supply partner? Do we think one is coming? There's a whole lot of catalysts in the near-term supply. And then on the exploration side, a lot of the times that comes down to a very technical look on do we think you could be successful in defining a resource, and then do we think that resource could actually turn into anything? Mm-hmm. So on the exploration and development side, very business as usual, but I would say that there is so much growth that's required out of each of these markets within battery metals that we're taking a broad spectrum approach and doing everything from mature companies all the way down to the niche, more concentrated early stage bets.
Mm-hmm. You mentioned earlier about the current geopolitical tensions going on in the world and obviously what's happening in Ukraine. Can we just sort of dive down that a little bit sort of deeper as to what you think both, I guess, the short, medium and long-term impact would that be on commodity supply chains?
Well, so first of all, I can't, there are some things that they're very difficult for me to form a view on around the resolution of the conflict and what that does. So the medium term is actually the hardest to predict. Sure. In the very short term and in the very long term, there are two things that are actually a conjoined force, which is people are very much more conscious, say in the first quarter of 2022 than even in the third quarter of 2021 around where things come from, right? And so that focus is something that we've been talking about. You and I have been talking about. Whole mining industry has been talking about this, but now all of a sudden, the whole public understands where things come from matters, and we're in this living example. That's probably the single most profound effect. What's interesting about that is that, in a way, it hardwires, from my standpoint, I think that this is hardwiring the demand story for energy transition, right? It's not, the second thing that it's doing, which is actually quite logical, is people are stepping back and saying, wait a minute, for us to actually satisfy all of our needs, it's going to be a bit of all of the above, right? You saw in COP26 softening of language from the elimination of coal to the phase out of coal. Right now, coal is providing very important energy into Europe at this exact moment in time and across the world, and is obviously very resurgent. But if there's a recognition around all of the above is required, that's also because a huge portion of the supply chain has just been taken out or eliminated. And so now everybody's saying, yeah, really, we need all of the above to get us through this energy transition. But I don't think that it has slaked the demand picture. If anything, it has, as I said, cemented it. You know, everybody says, okay, great, for us to hit energy independence, we're going to need more renewables and more batteries to capture intermittent renewables, and we're going to need, you know, more wires, more copper, more aluminum. You know, how are we going to do this? And so that's probably the long-term implication that I'm drawing from this, is that if there's a period where these legacy assets are still required, the long-term picture to me at the moment feels firmer around public demand and government support for transitioning into higher penetration of renewables and batteries.
This might be specifically a UK perspective, and it might be one of those things that just is talked about a bit in the UK press now and has faded away in the next few months. But in the UK press currently, there's a lot of talk and chatter about whether we should be moving away from our net zero targets. So Nigel Farage, sort of post-Brexit, that's one of his sort of campaigns that he's now currently spearheading. There's a lot of talk that we as in the UK should relook at fracking within the Bolan Basin. Taking the I guess the other side of what you just argued, is a possible consequence of the geopolitical situation in Ukraine that people might sort of move away from renewables and back towards things such as fracking and back towards coal?
I think it's very challenging to, you know, let's move back in time. Okay, let's go back to 2020, 2019, even 2021. The thought process was, it's all going to move. It's all going to move very quickly, right? And that's because society is demanding it. It's in line with the Sustainable Development Goals. Corporations are embracing it, and governments are legislating it. So that desire to move to net zero is not casual. It's not. Yeah, it's not casual. It didn't just, you know, I think that there was a broad-based consensus agreement from many, many sectors, and the investment community, with the rise of ESG funds and sustainability and sort of the my investment dollars mean something to me beyond just, you know, pure economic return. The whole world has moved in that direction. It's very hard to retrench from that. So will people roll back net zero commitments? I think the answer to that is no. Will there be a very strong desire to see legacy asset businesses run and provide a cost-effective backdrop for that to emerge? You know, that's where I think we are right now. So people are saying, okay, great, we can't turn off all coal, we can't turn off all gas, we can't, you know, just switch in a year, because guess what? Drum roll. The supply chain of materials to do that, in the know-how and the factories and all of that isn't here yet. I mean, it's just not here. So I think that there's kind of a timeline awareness that has come out of that's, you know, I can also say that it is impossible still, even for all the prices, it is impossible to form capital for coal. Or impossible. It's very difficult to form capital for coal. Most people are really banks don't want to lend to it, insurers don't want to insure it, and that's because it's still viewed as a disappearing business, and so it's a hard business model that will still be hard. That's probably, you know, so directly to your question, I think it's more about time frame.
You just mentioned coal there. Would you consider investing in clean coal technology and carbon capture technologies as part of the energy transition solution? Or...
So we are looking explicitly at carbon capture technology, and, you know, whether that's enhanced EOR, which is a way of creating low carbon traditional, you know, oil and gas, you know, complemented with carbon sinks, or on and on. There are models that work, and you've seen a lot of big energy investors shift towards decarb technologies. There's been a number of SPACs in the market that have transacted around decarb technologies, and the amount of interest and money around decarbonization is still very strong. In fact, when we talk to our investee companies, our portfolio companies, one of our first starting points of discussion is, again, build your business to satisfy what your customers or your customers' customers need. Understand your own carbon footprint as a first step and work to reduce it, because even though things have swung a little bit in the other direction, that's still very real, and people are still looking at scope 1, scope 2, scope 3 emissions. There's a tremendous explosion of technology right now that's sort of rooted in the essence of efficiency, higher efficiency, heat waste capture, more efficient motors, better practices, all the rest that's around decarbonization, hydrogen trucks, on and on. There's just a whole field that's exploding in innovation around how can we deliver that so that the materials that miners make provide what the world wants, which is lower carbon inputs. So on that side, absolutely.
What is the role of China in all of this? I know that's a very, very broad sort of question, but I mean, in this conversation, we've touched on the energy transition. We've touched on the politicization of metals and mining. Obviously, China sort of powered the last mining sort of super cycle. But what is sort of China's sort of role sort of like going forward in the energy transition? And are there any sort of particular sort of like observations that you have?
Look, I think it's very clear, actually, where if you look at government policy, investment dollars, commitment towards airborne pollution reduction, on the face of it, probably one of the largest direct investors in decarbonization and renewables is China. And so that is following on from government mandates and through to what their population wants. And so I think that it is, I don't particularly view the world, in some of these bigger trends as being China, non-China. I think it's all part of a general trend.
Sure. And I guess just as well, just kind of like another sort of slightly sort of like random question as well, because the last time both of us met, we were in Riyadh for the Future Minerals Forum. What is the role of the Kingdom of Saudi Arabia in all of this? Because we were like both at the event. I was wondering if you had any sort of takeaways of that event, and in particular, I guess, as to sort of like how that relates to the energy transition.
Sure. So I thought that the event in Riyadh was eye-opening to me in terms of the sincerity of the commitment from Gulf states, and it really been aware for a number of years around this is a business model that will change over time, where the governments that are supporting all of their populations entitlements and tax base and all of the rest through resource rents are needing to shift and change away, right? So if you think about it slightly differently, the cost of healthcare is rising. Perhaps, I don't know if it's exactly the same in Cincinnati as it is in Riyadh, but in all cases, the cost of healthcare is rising. People are living longer. Demands of entitlements are up across the board, and there's a lot of fiscal pressure on people that have hydrocarbons as a primary source, like the Gulf states, to diversify and change. And so if you look at the Vision 2030, it's a very prescriptive, now we're going to explore, now we're going to build a mining sector, and it will take a generation for it to be fully vibrant and have a risk-taking culture and generation, but there's a tremendous amount of government support. Pause for a minute and think about who else is doing that. The United States is doing that. The United States is saying we need to spend hundreds of millions of dollars into reinvigorating the USGS. We need to map all of our critical minerals. We need to have higher access to our federal lands for energy transition. We have now the DFC is able to invest in critical minerals and which is a pretty broad-based bucket. So you're seeing state capitalism come out of the United States, out of Riyadh for sure, out of the European Union, where Germany will provide loan guarantees for mining companies that are sending battery minerals through to German gigafactories. So we're actually in a really interesting place where the emergence of state capitalism in this market is going to actually just provide, it's just going to accentuate the winner loser paradigm, where in order to access that, you must be politically savvy, you must be politically connected, you have to be running a business that is based on more than rocks, right? And so therefore you have to be conscious of ESG, stakeholders, and and carbon, and that can help unlock, and supply chains, and that can help unlock a lot of things. So I guess the twin to that is we have seen Tesla out there transacting and doing offtake contracts, GM, and I think you'll continue to see automotive companies reaching through their battery manufacturers to having direct access to to battery materials, because everybody's trying to grow and there's not enough supply to go around. So that's another very interesting trend that is a close parallel to the emergence of state capitalism.
Do you think, just think to your comments about Tesla there, we see a greater integration between the downstream supply chain and the upstream supply chain? So we'll see a Tesla maybe sort of like take over like a mine and sort of buy a mining company in the near future, or like vice versa?
I doubt very much that a mining company will take over Tesla. So let's just take that one off. We'll take that one off the books.
Okay.
Yeah, look, what I do think is that you'll see, so let's look at the Japanese steel industry in the 70s, right? And so they had, still have JOGMEC out supporting early stage developments, a government body that's out supporting high risk capital that you can use to help feed Japanese steel mills. And then there's an integration between trading companies and direct ownership of mines by steel companies, whether it's a coal mine or an iron ore mine. What you saw was the steel companies reached out and said, I want to have my hands on supply. Some of that is a hedge against price volatility, where if the price of the raw material jumps, at least I've got some kind of a hedge on what it cost me to get it. That's very smart business. The other part of it is actually security of supply. So now my supply is secure. I know where it's coming from. That creates more predictability, and you get insight into what's happening in the supply chain, and that can help influence your business model. And then so if there's one is a financial hedge and two is security of supply, the third part is in particular around minerals where impurities can matter around performance.
Mm-hmm.
You can, and that happens in, say, different lithium, different parts of the lithium value chain, where you can be very conscious of what your impurities are and how that impacts the the ultimate downstream formulation. You will see more integration. So the less homogeneous the product, the more integration you'll see. And so when you're thinking about aerospace and defense into rare earths, very easy to see 5-10% shareholders in rare earths companies. It's very easy to see 5-10-15% shareholders in the next generation of battery minerals that are coming from downstream. And that's just the way the world is going right now, because it has to.
Mm-hmm. We started this conversation with me asking the question, are investors leading the way in the energy transition? I guess a closing question would be, are the mining companies, or how well are the mining companies playing a role in the energy transition? And if they are falling short, what could they be doing more of?
Look, there's some very courageous people doing the best that they can. One of the things that across the mining value chain, and I think that the single hardest part that every mining company is faced with is the persistent shortage of people. So people build projects, people build mines, people execute strategic partnerships, and run companies. And it's an industry that has fallen short on the promise to young people coming in. And so there's just actually, when you go around, you say, I need somebody to handle this project and build this mine for me. It's a really thin register. And what happens is it goes across the entire industry. So it's not like there's a lot of people working in gold who, are not working in lithium. There's just not a lot of people in the industry. So when one segment or another is moving very quickly and wanting to grow, it pulls the people aspect out of shape. And the second is that when it's all going, it makes everything extraordinarily tight, and that impacts cost, efficiency of execution, ability to get things done, and on and on and on. So the services sector right now remains, I think, one of the most interesting areas where companies need to, they need to find capacity that they don't have, and they'll look to the service sector to do that. But ultimately, it's a pan industry. The lack of people is a pan industry issue.
Well, thank you very much for that, Matt. I think we're out of time. It's always a pleasure having you at Mines and Money. Hope to see you in sort of like person in the flesh again at one of our events later on this year. But until then, that was Matt Fifield, Managing Partner of Pacific Road, with Andrew Fake from Mines and Money. Thank you very much.
Thank you.